God damn, look at that little fire. Gotta get the maintenance to come fix those things. Anyways, some of you asked about SQQQ, and this is just gonna be something that you open up and listen to. So you should just listen to this as a podcast. I will just explain how SQQQ work, and then there's some mixed signals that because the reverse split is coming on the 13th. So for those of you who don't know what SQQQ is essentially a inverse leverage fund, which means, so for example, when the Nasdaq goes up by 1%, this 3x inverse leverage fund will lose. Let's just say you invest $1. Let's say you invest $1. $1 would be a very bad example. Let's just say you invest $10 in SQQQ. Okay, $10 in SQQQ, and let's just say the Nasdaq went down by 1 point. When the Nasdaq went down by 1 point, that means your SQQQ, or 1%, or whatever percentage that it went down by. So let's just say Nasdaq went down by 1%, and then because SQQQ is a 3x inverse leverage fund, that means your $10 investment in SQQQ will become $13 actually. Does that make sense? And then if the Nasdaq went up by 1%, that means you lose $3. Right? 1% of $10 is $1, and then 3x will be $3. So you have an implied 3x leverage. Okay. So we explained what SQQQ is. What you just need to know is it's kind of like a highly risky sort of endeavor to do, because if you were shorter the market, you're essentially 60% of the time the market is against you. Because if you go look at 40 years of Nasdaq data, 60% of the time Nasdaq will go up and 40% of the time it will go down. And then the general momentum is always going up, except for certain years. So Nasdaq tends to be a very momentum driven or sentiment driven. Well, sorry, I think there's a train moving by or something, or yeah. I don't know if you guys can hear it or not, but basically how it works is Nasdaq is really sentimental. What do I mean by sentimental? It's really driven by the sentiment of the market. It really is driven by the sentiment of the market, especially after 2018. Okay. So go back to the SQQQ. SQQQ is going to have a reverse split, 1-5 reverse split, by the morning of January 13th. So if we count the date, tonight is January 11th, tomorrow is 12th, and 13th is just the day after, right? So tomorrow is Wednesday, and 13th will be the Thursday. So on Thursday, the one share. So basically on Thursday, what will happen is one share of your SQQQ will become 1/5 share of SQQQ, which means the share price of SQQQ will go up from $1 to $25, but the amount of total outstanding share will be 5-folded, which means like divided by 5. So at first, you have, let's say, 100 outstanding shares. After the reverse split, you will only have 20 outstanding shares. Before the reverse split, let's just say the stock is $5, there are only 100 shares. After the reverse split, 1-5 reverse split, you will have $25. The stock price will be $25, but the share amount will also be 20. Does that make sense? $5 times 100 equals 500, and 25 times 200 will still be 25 times 20 will still be 500. So the total value of the stock doesn't change. But when reverse split happens, usually what will happen is the stock tends to go down, because the reason why for a index fund or for ETF or for any stock to do a reverse split is because they're running into liquidity problems. Well, look, there's a plane, yay! And then so the reason why fund would do reverse split is they have a consideration for delisting. So, but the thing is, this SQQQ reverse split consideration is really, really interesting or intricate, because right now the market is very volatile. And then if you go like a VIX or SQQQ, you will realize that, hey, we have a lot of ups and downs and ups and downs and ups and downs, but the SQQQ and VIX are actually trending down. That means the Nasdaq still have the momentum to go up. But what else do we know is we know the interest rate is going to increase way before than we normally expected. So let's just say the Fed decided to increase the interest rate in March. No problem. Everybody anticipated that. A lot of people already hatched for that. But let's just say if the Fed decided to increase the interest rate in February or in January, then a lot of those people who right now have a temporary upside momentum leaning psychology will be stop loss rated and will be short rated basically. And the timing of SQQQ reverse split is really intricate. It's because 2 days ago we just have a very, very sharp downturn. And today we have a recovery. And then if you go look at the calls and put volume, the put walls and call walls and stuff, you will realize that majority of the market still believe that before January 24th, there's still a upside. Therefore, with huge considerations, the fund manager of SQQQ decided to do this reverse split. Well, actually, they didn't really decide to do it right now. They decided to do it on December 22nd, which is last year. And what makes it sort of creates noise in the general, not really shorting community, but the community that believe that there's going to be a huge correction is whenever SQQQ actually reverse split, it usually signals a small bull run in the next 25 trading days. So now we're in a dilemma of, in December 22nd, the fund manager of SQQQ thinks that the general market is still fine. At least it's still fine until 25 trading days after January 13th. But if you go look at Jay Money or Jay Powell's interview online or Bloomberg 2 days ago or a day ago, you will realize that, hey, the Fed is really hawkish, and the Fed really want you make the taper faster and really want you so we're waiting, basically tomorrow we're waiting on the inflation data. If the inflation data is really, really bad, then we're actually expecting an interest rate hike in mid-February or even January 24th. And if on January 24th the interest rate actually hiked, then this reverse split SQQQ will actually be really profitable. It's just really hard to determine like what are you supposed to do with SQQQ, because we both know in the long run the market is going to correct anyways because of the interest rate, but the timing is really hard. Like so another consideration you have to think about is the reason why they do reverse splits for SQQQ, not only because of liquidity problems and they don't want to get delisted, but also the fact that when they reverse split, it's actually harder for people like retail investors to short the market. Why? Because right now you can short the market $5 per share, right? For 100 shares of SQQQ, it's only $100. If you buy the options, it's only $20 to share 100 shares of that. That means you can actually jack up the leverage and basically, if you were a retail investor and you didn't hedge at all and you decided to short it this Monday or last Friday, like what I did, buying a bunch of SQQQ, then you are looking at a 2.5x leverage to about 5x leverage, which literally just means on Monday, if you just do not do any hedging at all, you can double or even triple the amount of holding in your portfolio. So when they're reverse splitting this, that means they're basically cut your leverage by whatever amount that they're doing the reverse split with. So in this case, it's 1 to 5. So let's just say beforehand, you can do it at 5x leverage. Right now, it's only 1x leverage. That means your leverage is decreasing. That means it's actually harder or more expensive for a retail investor to short, because for institutional investors, they don't care. They just short the index anyways on the NASDAQ. For us, because we don't want a huge exposure to the short side risk, therefore we use ETFs to short. And then the risk of holding ETFs to short is because the highly volatile nature of these ETFs. And when these ETFs are higher, especially for shorting funds or shorting ETFs, that means you have a bigger upside. But when it's only $5, that means your upside, downside, you have a bigger downside. But when it's only $5, your downside is actually really limited, because when, let's just say SQQQ goes to about $2.5, it definitely there will be a correction, okay? It has to be, because this is what big data is telling us. This is what 40 years of trading data is telling us. So right now, they're either trying to send out a smoke screen and telling retail investors that buying shorting ETFs is not a good idea because they literally make it 5 times harder for us to short, or it's just a interesting consideration, and they're afraid that, you know, it's just a contingency effect for them. Reverse split doesn't really change the value of the underlying asset. It only makes the sentiment goes the other way. And if you want to know the specifics of you know, previous time they reverse split 5 times over the past few years. The earliest one is 2012, and only one time after reverse split their stock went up. So yeah, this is very interesting consideration there. I think this is it for the video. I'll upload it real fast. Hopefully you guys, well, you just listen to this as a podcast, and then on YouTube I will do another, let's just say, another video on this with visuals. If you guys want to see some visuals, and I'll give you some data and all this kind of stuff. All right, smash the like button and subscribe. See you guys on the upside.